We have been humbled by all of the many folks that have contributed to the webinar series. And so in this episode 12, it is time to put together our panel discussion. So for the benefit of our panelists, we have 3 questions that we're going to ask most of you, maybe not every question to every panelist, but most of you. And so think about your answer. We'll call you out and then you tell us what you think. So the first question is an important question. And here it is. I want to lay it out before you have to answer. What is the biggest danger facing investors today? Before we get your answer, do you want to elaborate on that, Russ?
Yeah. So, when each of you are out there and you're looking at a specific corner of the financial universe, you're watching different parts of the financial system, the economy, you're looking for clues and triggers and things that are sending a warning signal. And you're probably going to see those things before a lot of the folks watching this. So we want to know from you is like, what do you see? What do you think people should be thinking about, especially things that maybe aren't on the average person's radar?
So question number 1, we'll start with Dr. Chris Martenson. Chris, what is the biggest danger facing investors today?
Complacency. People who are rooted in the idea that things are going to get back to normal. The Fed's got this under control. That's going to be the thing that's going to get most people. They're going to get sucked back into a model that just isn't going to work out.
Thanks, Chris. Hey, Adam, do you have a different answer?
Price discovery. We don't have it right now. People are buying assets at prices that really aren't rooted in the fundamentals. Are fundamentals ever going to matter again? We don't know. That's the risk.
Thanks, Adam. Hey, Nomi Prins, what is the biggest danger facing investors right now?
I think the biggest danger is really a two-pronged situation, which is that the health and safety issues that are facing the world right now because of this pandemic go through a second or third or fourth or whatever leg. So that, we think we might be getting somewhere out of the woods and economies start to reopen and markets start to feel better. And of course, the central banks are there to help bolster that along. But then the health concerns rise again. And I think what that will do, if it happens once or twice or 3 times or any multiple time, each time it will create more uncertainty in the economy, and it will create more uncertainty in terms of planning and in terms of investing. And I think that could be detrimental over whatever time period that happens over. So that's a major danger. You open too fast, there's too much of a health hazard, too many people die, and the economic growth that you could have had actually retracts because of that uncertainty and that fear. So that's a very big danger. It's hard to plan in those situations.
I believe the biggest danger facing investors right now is the risk that the government doesn't continue propping up the economy by having additional multi-trillion-dollar rescue bills. We need to see more government money being spent as it has been spent over the last few months so that people can continue paying their rent, they can continue paying their mortgages, and small and medium-sized businesses don't fail, and the largest corporations don't fail, and all the banks don't fail. So that's an enormous risk. If the government gets cold feet and spends too little or too selectively, then we could collapse into a depression and all the assets would spiral into an enormous debt deflation disaster. So that's the real risk the world is facing.
Richard, Duncan, thank you very much. Danielle DeMartino Booth, what do you think?
I think what investors need to realize is that the Federal Reserve can postpone insolvency, but they cannot prevent insolvency. So investors right now should understand that their greatest danger is that if they're completely long stocks, they need to be hedged.
Well, I think it's inflation. I think the inflation is what the Federal Reserve is creating. A lot of people are asking the question, when are we going to see the inflation? We've already been seeing the inflation, and now we're seeing even more of it. The inflation is the expansion of the money supply. Right? The Fed is inflating like never before. The question that investors need to ask themselves is, when is the inflation going to move from domestic asset prices, U.S. stocks, bonds, real estate, into real stuff, right? Into consumer goods, right? When is it going to go from the stock market into the supermarket, right? Because when inflation is causing the stuff that you own to go up in price, people feel good about that. Oh, I'm richer. But when it makes the stuff that you need to buy to live go up in price, that's when you realize that you're poorer. So that's going to happen, right? Once the inflation was created, the inevitable final resting place was a foregone conclusion. Obviously, the path that it takes to get there may not be what you expect. It's taking a little bit longer. There's a bigger lag than would normally exist. But investors need to now be prepared. The inflation tax is ultimately the way that all Americans are going to pay for this dramatic increase in government spending. There is no free lunch. We have to pay for all the government we get. Government spending is the equivalent of taxation. It must be paid for. It's going to be paid for through inflation. That means owners of US dollars and dollar-denominated financial assets are going to get stuck with a massive bill. And if you don't want to pay that bill, then get out of the dollar right now and get into these foreign assets.
Well, I tend to agree with most of the experts out there. It is, the danger is what we're seeing right now. The COVID pandemic was the pin that pricked a bubble that was already there. And what we're seeing now is that the cure for this crisis, the cure for this economic portion of the disease is over the long term going to be worse than the repercussions, the immediate repercussions of the disease. It's really just putting all of the trends that we've seen, the long-term depreciation of the dollar because of the massive debts that have been accumulated. All of these trends are being accelerated right now. And unlike 2008, where it was a financial crisis and much of the response was aimed toward Wall Street, and therefore most of the inflationary aspects were confined to Wall Street and financial assets. This time, much of the policy response is being aimed toward Main Street. They used to talk about helicopter money as being something the Fed could do to avert a deflationary event or even a depression. Well, they don't need the damn helicopter. They have direct deposit. And that's what we're seeing right now. They're just funneling money, creating money with keystrokes and delivering them directly into citizens' bank accounts. So this time, unlike 2008, we are definitely going to see real world inflationary effects from all of this, this policy response, from all of the stimulus. And that's just going to be another factor that's going to supercharge gold and silver prices. So again, I think that's the way that investors need to insure themselves against some of these repercussions that are not only inevitable, but now imminent.
Well, thanks, Brien. Let's consider it from an oil perspective. Art Berman, can you weigh in here?
I think the biggest challenge facing investors is to understand just how serious the economic effects of this COVID-19 related economic closure are and how long that is likely to last. And oil turns out, since it is the economy, to be an awfully good way of looking at and thinking about that. And so most of the forecasts, not only for oil, but for the economic recovery, I believe are wildly optimistic. And I base that not on my opinion, but based on the research I do with oil. So if we look at the relationship between oil consumption and GDP for any country in the world or the entire world, you will not find a better statistical correlation anywhere. And we can argue all day and all night about why that might be the case, but it doesn't matter because it is. So right now, oil consumption is down about 20% worldwide. And so when I read a report that says the GDP is down 3 or 4%, I have an unmentionable response to that because it just doesn't make any sense. It's based on somebody's spreadsheet, or who knows what assumptions go into it. But I mean, you can annualize whatever you think the drop in oil consumption is going to be. I have not seen any credible forecast that says it's going to be less than 7, 8, or 9%. I think it's going to be more like 15%. And so if we're looking at a at a GDP decline annualized over 2020 of anywhere more than 5%, certainly in the 5 to 10%, which is, I mean, I've seen estimates that go up to 50%. So be careful what you believe is my point. I'm very optimistic that we will recover from this. It's going to take a long time, and the world is going to be different. And the way we think about and use energy is going to be different. And nobody has a clue how that's all going to evolve. But my basic advice is be very careful about rose-colored glasses, believing in V-shaped recoveries. And if you want to understand why that's not only unlikely, I'm just going to get out there and say it's impossible. And that's because the trajectory of oil consumption and oil production, by the way, it doesn't work like that. It never has worked like that. And it isn't working like that right now. And just to give you an idea, we talked about geopolitics and how the U.S. is suddenly the top oil producer in the world. Won't be in 2020. I think U.S. oil production will be down 50% or nearly that. In 2020, we are no longer going to be head and shoulders with Saudi Arabia and Russia. And that has huge implications that I don't think hardly anybody is thinking about right now.
All right. Thanks, Art. Hey, let's talk a little real estate. Kenny McElroy, what's the biggest danger facing investors right now?
I think that capitalization, their own internal capitalization is, I think that we're still, we still don't know. Lenders are starting to increase their reserves. Things are, they want it. People don't want to, default. And so, I think capitalization and cash and liquidity is one of the biggest dangers that we have right now. And if people can, they have to figure that out in the next few months.
Tom Wheelwright, CPA, what do you think?
Oh, not adapting, thinking that things are going to be the same. I think that the innovators are going to be the winners, and those who wait to react and wait to see what the government's going to do and wait to see what's going to happen, I think those are going to be the big losers. So I think those who plan ahead, who make innovative changes, who make adjustments to the way they're doing business, they're going to be the big winners, and pretty much everybody else will be the big losers.
And let's wrap it up with Robert Kiyosaki. Robert, what's the biggest danger facing investors today?
Complacency. This is the biggest opportunity in world history. That if you're not changing your vision over the horizon, you're finished. Because the world completely changed with Corona. As much as I don't like it and all this, nobody likes it, nobody wants to die, but the world has changed forever. It'll never go back. So just know the dominoes have not yet started to fall. The good news is those are opportunities. You look at, I have commercial real estate, but as Gene Guarino know that we're shifting to old age housing. So we're still in commercial real estate, but we took a health club, and we're converting it to senior living in a rich neighborhood. So it's just how you look at the problem. There's more opportunity as the world changes, but if you don't change, it looks the same.
All right, excellent stuff. And thanks everybody for those thoughtful answers. Our second question revolves around what can people do when it comes to investing. We're going to start with what might be the best defensive posture. It's an interesting time with everything going on. We're going to play both offense and defense, but when it comes to investing choices, what are some good defensive strategies?
Warren Buffett says that the first rule of investing is don't lose money. And the second rule is to never lose sight of rule one. Every championship football team knows you've got to play both sides of the ball, and defense is important. They say all the time, defense wins championships. I played defense, and our rule was if they don't score, we can't lose. And so as an investor out there, especially someone who's accumulated some wealth, these folks are now concerned, like, how do I hold on to what I've got? Yes, I'd like to grow, but I want to make sure before I maintain my base to grow from. So we're looking for feedback on how can people preserve what they have, navigate the problems you see coming, and emerge on the other end of it to be able to take advantage of opportunities from a position of strength.
All right. So question number 2 is, what's a good defensive strategy or defensive position? Let's start with Richard Duncan.
Of course, every investor is different. Playing defense when you have $10,000 is a different game than playing defense when you have $10 billion. So one size answer doesn't really fit all, because different defenses are required for different amounts of wealth. But I think for normal individuals, most normal Americans, one of the best defensive plays is to own rental property. Build up over the next, depending how old you are, as long as you possibly can, a portfolio of rental properties, not condos, but pieces of land with houses on them that you can rent out. And because there's no limit as to how many condos can be built into the sky, but there is a limit as to how much land there is in the world. So land is very defensive, and it's like gold. If gold goes up, then land goes up for the same reason. But on the other hand, no one's going to steal your land. When you wake up in the morning, you don't have to pay people to store your land. You can actually have a house on top of it and rent it out and generate good rental income year after year, if you are not too highly leveraged and can weather any downturns. Because of course, rental income can drop much more than you anticipate. But so I think building up a portfolio of residential property is a very good investment strategy for young people. I mean, for people of all ages, but people who are young, they have a lot of time they can build up a big portfolio that will make them, very, very comfortable at the least by their middle ages or by the time they're 60. So I think that's a great defensive approach.
Thanks, Richard. Own rental property. Always love that answer. Hey, Danielle DeMartino Booth, what do you think?
Well, for me, the best offense is a great defense. I think that a lot of municipalities and states in the United States are about to be tested. But by the same token, sometimes you get the baby with the bathwater phenomena, and I own a ton of really good municipal bonds, and I find them to be a great buffer for the overall portfolio. And of course, I've built up my gold and silver positions as well. If you're looking as an investor, though, you have to study balance sheets. You have to say, what company is going to be with us in 10 years and can survive this and continue paying their dividend? Those are the keepers.
So I think that the best defense to this is if you have money or access to leverage or loans available to you as an individual, an investor, a company, is not to go all out, not to sort of let's call a bottom, let's go to, put everything on red in one opportunity. But basically, I like to think of stepping into sort of these new opportunities in three separate steps. Dividing what you have and what's available to you in three different pieces. So that you see an opportunity, you only put a third of what you have or what you have available down into it. Then you wait a little bit. And then you put in another third, and then you wait a little bit, and another third, and then you wait a little bit, because I think that way you can also get a lay of the land. Are we seeing another pattern of increased virus cases or deaths? Are we seeing economic growth besides that? Are we seeing more development of ways to bridge those two scenarios? And that way you keep your money and financing and leverage fresh. And also, if new opportunities happen during that period, you can actually take advantage of multiple opportunities without having just put all your eggs in one basket.
Well, you got to defend yourself from inflation. Right? So you need inflation hedges. You have to defend your purchasing power. So number one, you think gold and silver, right? Because that's real money, right? The government is creating funny money, paper substitutes for the real thing. But all that money is going to lose value. So to the extent that you want to be liquid and you want to just hold on to some savings, right? You're worried about financial assets or property, and you want to have some dry powder to buy things in the future. Where are you going to keep that dry powder? Obviously, in real money, gold and silver. Traditionally, if you opt for gold and silver, there is an opportunity cost because you give up the interest that you would otherwise earn on your bank deposits. Well, you don't give up anything now. There is no interest. All you have is risk You're giving up that risk for the safety of real money. So number one would be gold and silver. But number two is, hey, if you really understand what's going to happen to gold and silver, why just preserve your wealth when you can dramatically enhance your wealth by investing in gold mining companies? Because they have all this gold that's in the ground, right? It's in storage deep in the ground. But the interesting thing about gold companies is a lot of the gold that they own, the market assigns zero value to that gold. Why? Because it's too expensive to produce it profitably. So let's say gold is 1,700 and you've got this huge deposit of gold in the ground, but it costs you $2,000 an ounce to get it out of the ground. That gold has no value because by the time you bring it out, you lose $300 an ounce. Well, what if gold becomes $5,000 an ounce? How much is your $2,000 gold? Even if the cost of mining it because of inflation goes from $2,000 to $3,000, if you can sell it at $5,000, now you make $2,000 an ounce on gold that was valued at zero. So while the price of gold could go up 3 times, 4 times, gold stocks can go up 10 times, 20 times, 50 times. So there you're not just talking about preserving your wealth. You're talking about an opportunity to dramatically grow your wealth, right? Obviously, if I'm wrong, there's a lot more risk in the mining stocks. But if I'm right, there's so much more upside potential. And I think the upside potential is worth the downside risk for the people who want to take some downside risk, right? So gold stocks, I think my gold fund is the best one, managed by Adrian Day, Euro Pacific Gold Fund. We also have separately managed accounts where we will manage your portfolio. And if you're just buying the big companies, anybody can do that. Anybody can buy the Newmonts and the Barracks and the Franco-Nevadas and the Agnico Eagles. Where Adrian really adds value is with the juniors, the smaller companies, because there's so many bad ones out there that you have to avoid in order to get the good ones. And when you've been in the business as long as Adrian, 30, 40 years, you know the mines, you know the companies, you know the projects, the management teams, all that. He is uniquely qualified to add a lot of value in that sector. So that's where the home runs are. That's where the 50 and the 100 baggers are, right? And so the gold stocks, I think, are a great way to go. And then for people who want less risk, my strategy is, look, buy defensive companies, property trusts, utilities, telcos, tobacco, energy companies that pay really good dividends, where the dividends are going to outpace the cost of living in the U.S., where you have dividends denominated in currencies that will retain their value because they're not the reserve currency now. They're just a currency. So they're not going to have a significant markdown when we remonetize gold. I mean, I think all currencies will lose against gold, but none of the good currencies will lose anywhere near as much as the US dollar. And the good thing about having a portfolio of good value foreign stocks where you're getting, you're paying low PEs, you're getting good dividend yields, is even if I'm completely wrong, you don't necessarily lose money. You can still do very well by buying quality foreign companies at a discount and getting good dividends. You don't need anything bad to happen here. You don't need me to be right on anything. And you can still make money on that portfolio. I mean, I have to be right for you to make a lot of money on gold, but I could be wrong and you can make a lot of money on these foreign stocks. So it's a good hedge.
All right. Thanks, Peter. Real estate wise, Ken McElroy, what about defense?
Well, I'll tell you what we did in 2019. We sold what we called our bottom 10 projects that were tight. They were, we didn't see any rent growth. Maybe we had markets that, were, even as markets were going up, not all markets go up. Some markets are flat. And so we exited a number of projects, 12 projects in 2019. I think people should sell anything that's tight right now and scoop the liquidity. We just did this. I had a property in Tulsa, Oklahoma that, the return's tight, the cash flow's tight, and it's been, a lot of management effort on it. And for multiple reasons, and, Tulsa, Oklahoma is wrapped around oil. But regardless of that, we had a 1031 buyer come in and, we're in escrow right now and they're doing due diligence right now. And we're locked and loaded on a low 4 cap, and we're going to scoop a bunch of equity, pay it out to the investors and move on to another market. because we think that we're going to have further disruption. So anything that's tight, anything that requires a cash call, because I went through cash calls in Austin in 2005-06, and I went through cash calls in Houston, where literally we were writing checks. And so a lot of people haven't experienced that before. Cash calls to the investors, or writing your own checks, or whatever it might be, or diluting partners and those kinds of things. Those are going to start happening. So get rid of those now so you can maintain those relationships both on the lender and the equity side.
Great answer. Tom Wheelwright, what do you think?
Well, I actually think now is the time to entrench your business and look at what are your best business practices, because that's defensive. Defensive means you have a solid foundation. It means that you're not, the winds come, they don't easily blow you over. The hurricane comes, your house isn't lifted out of, off its foundation. So it's that really good foundation. And I think having a good plan of action in place, what we would call a strategy, for building your wealth and for taking care of your business and, moving forward, I think those are the people who are going to be able to weather this the easiest.
For defense, I think right now it's wise to play for that blood in the streets moment. Don't know what's going to happen. Prices completely divorced from reality. Build some dry capital, whether that's cash or just being in liquid securities, so that if prices do come down to fair valuations, you've got the ability to step in and take advantage of them. And history has shown that those who had dry capital to deploy at major corrections in life were able to get those generational bargains that created real long-term outsized returns.
Robert Kiyosaki, what's a good defensive strategy?
Well, you got to stay healthy. And that's why I just got off a 21-day cleanse with Radha Gopalan and his sweetheart and all this. It doesn't cost a lot of money. It just means change what you eat for 21 days. So I go through withdrawals, no coffee, no alcohol and all that stuff, no junk food, clean living and all this. But health comes from what you don't put in your body. And vaccines is one thing I don't want to put in my body, or drugs is one thing I don't put in my body. So that's why I talk to people about health. And what Radha Gopalan, who's a cardiologist, says, the insurance companies are not about healthcare. It's about wealth care. It's to make them richer. And then they determine, the insurance companies determine what is health. And they don't make much money when you go on a 21-day cleanse. All it is detox powder and water and green vegetables. And it's very healthy. Doesn't cost much money.
All right. Thanks, Robert. We certainly can't argue with better health. Hey, Brien Lundin, let's talk precious metals. What do you do there in terms of a defensive strategy?
Well, I'm like a broken record on this. My view is that gold and silver are the way you play defense. You shouldn't look at them, or you shouldn't look at the foundational gold and silver aspect of your portfolio. You need to build a foundational physical metals holding that you look at as insurance and not as an investment. You sock it away. You don't worry about the price of gold or silver on a daily basis, and you sleep better at night knowing that these physical metals are ensuring your wealth against the inevitable depreciation of the dollar or whatever currency you're operating in. There are ways to invest in gold and silver to look at this macro trend and leverage it through equities, gold mining equities and the like, or larger purchases of metals through ETFs or physical holdings. But initially, the physical metal holding is insurance, and the thing that everybody really needs to do at this point in time.
Let's wrap this one up with Chris Martenson.
Well, a great defensive strategy for me has been, I bought a big piece of land. I'm getting a garden going. I'm actually getting some cows. Don't know anything about raising cows, but we'll learn. This is how you learn. You learn by doing, right? We'll make mistakes and we'll keep going like that. So I'm going to, my defensive strategy right now is to own real tangible assets, things that I can understand, get my hands into, in this case, get my hands dirty.
Awesome stuff. Okay, panelists, it is Final Jeopardy. Our third and last question is this. when we get through all this and when the new normal's here and when the bulk of it's behind us and we've changed our thinking and employed some of the things we've been talking about over the series, now let's talk about some offensive strategies. What can people do if they want to make more money, add to their portfolio, play offense?
Yeah, we say all the time that the flip side of every problem is an opportunity. And of course, being able to see the flip side is standing on the edge, having a perspective. And obviously, each of you look at the world through your lens, and you're going to see opportunities in different areas, in different corners, in reaction to different things that you see happening out there. So enlighten the audience, if you will, on where you see the best opportunities going forward.
All right, so best offense? Let's start with real estate guy, Kenny McElroy.
You got to harvest your equity without being too in debt. So we just locked two loans, one at 2.75 and one at 2.8, 30-year amortization. We did cash out refis and we did interest only. And on two projects, about 550 units, I think, combined in the two. And so we got not a ton of money, but a few $1 million. But our mortgage payments less and it's interest only. So what we've done is we've increased our cash flow, took out a little cash and locked long-term. These rates are so low that I think if you need to do it, even if you have a prepayment penalty, you need to wrap your head around the fact that you might have a big prepayment penalty. Because if you're holding for the long term, let's say you're holding for 10 years, it doesn't matter if you're paying $250,000 or $500,000 or even $1 million, because you might get that back with a lower payment in just 3 or 4 years. And the most important thing is that even if you don't get it back to 5 or 6 or 7 years, you preserve the asset. You have a little more cash to work with during the downturn.
That is wisdom right there. Thank you, Ken. Hey, Art Berman, let's talk about oil and investment strategies.
Defensive strategy, again, this is more complicated and it's riskier, is to short oil. And so if you, and I don't advise anybody short it with commodity futures trading or physical oil, but again, through the stock market. And so you look at, I have a cheap product on my website that deals with comparative inventory that shows you what I think the correct price ought to be. And when it approaches that, and it's darn close right now, within a couple of bucks, that says that it's going to go down. And so, you can short the stock of the same companies. That's a simplistic way to do it. But it's a pretty low risk way because you can get in and you can get out. There's not a liquidity issue, and if you blow it, you can get back in on the other side. So those are probably the best strategy for oil. If a defensive strategy is just stay away from.
All right, thanks, Art. There's oil. Let's talk gold and silver. Brien Lundin, best offensive strategy.
Yeah, well, if you want to play the trends, the first thing people need to do is not worry about whether the Fed should have done this or that, or Congress should not have spent this much money. You need to just look back, take the politics out of it, and look at it dispassionately and say, this is a new reality. How do I make money off of it? And the new reality is we're going to have ultra low rates going forward, interest rates, essentially forever. And they're going to be negative on a real basis, inflation adjusted basis. And we're going to have a monumental debt load in the US that has to be depreciated. So the currency has to be depreciated. So these are the macro trends going forward. What's going to benefit from that? Initially, financial assets, it's going to be bullish for equities in general. Real estate's a great investment. Of course, if done correctly, everything's subject to the details in that regard, as you all know. But gold and silver can be leveraged very easily. Silver leverages gold. Mining equities offer leverage to gold and silver. There are a number of ways to use these derivative investments, these gold and silver associated investments, to really multiply the gains in the metals. And they can be spectacular if you have a long-term bull market. Initially, the ETFs, GDX, GDXJ for the so-called junior miners, great ways to do it if you don't want to really dive in and do a bit of research into it. But there are inefficiencies in that market. And if you're willing to take the time and spend a little money to subscribe to good newsletters, go to conferences, you can learn about those more junior companies and play around in those markets with greater risk, but potentially much greater returns.
Now, Peter, you had some similar thoughts. What do you think is the best offensive strategy?
Well, I mean, that I already kind of covered that with the gold mining stocks. I mean, I think that is the biggest opportunity to go on the offense. But I think another way to go on the offense, even in stuff like what you guys do, is recognize that there's going to be some tremendous opportunities in the future in all sorts of distressed assets. So it's not simply about converting your dollars into gold now or gold stocks, but now beginning to think what you're going to convert that back into when you sell, right? Because people are going to have incredible opportunities when the time is right, if the time is right. I mean, if we become a complete socialist country, the time may never be right in our lifetimes. But if we learn our lesson and we do the right thing, in the environment of doing the right thing, there'll be nothing but blood in the streets. Things will be very cheap. Right. Anyway, right now, even Warren Buffett talked about this, that, he had a lot of cash and a lot of these companies that were in trouble were coming to Warren Buffett looking for deals where he was going to be able to write his own ticket. And then all of a sudden the bailouts came and they stopped calling him because the government gave them a better deal than Warren Buffett. Right. Well, when the government can't bail anybody out anymore because the paper money has no value. Right. And now you need real money. You need real investors to come in and pick up the pieces. There will be incredible bargains, right? To buy real estate, to buy businesses, all sorts of things. Really, literally, you'll be able to buy for, let's say, you bought something, you bought an ounce of gold, you'll be able to buy stuff with a 20th of that ounce, relative to what it would cost you now. Your gold will go a much further way. So you need to be defensive now so you have the ammunition to go on the offense, right? When nobody else does, when everybody is broke and paper money doesn't cut it, right? You're going to need real money. So that, and that would be the best situation, because that would mean that we've done the right thing, that we've swallowed that bitter tasting medicine. And even though we're at the bottom of a long tunnel, we'll be able to know there's light at the end of it when other people can't see it. Right? They don't recognize, because capitalism is extremely powerful. Look at what we built in this country in the 19th century with none of the technology that we have today. And so if we were so successful back then, imagine how much more successful we could be now, right? Because we're not going to lose. I mean, the stuff that we have as far as buildings and equipment and technology, none of that's going anywhere. Paper wealth is going to blow up, but the things that we have are here, even if somebody else owns them, right? Even if the people who currently own those means of production or those assets aren't the future owners, they're still here. And everything we've learned, all of our knowledge, we're not going to forget everything that we learned over the last couple of 100 years. And I think a gold standard, when we go back to it, will work even better now in the internet age than it worked back then. So we have all the equipment we need. The only hurdle we have to overcome is ourselves. We have to overcome the democracy impact, the something for nothing, right? But if we can just get the mindset right and re-embrace the principles that we once embraced as a nation of freedom and individual liberty and limited government and sound money. If we can do that, the society and the quality of living that we can build and the time it would take to build it, right? It would dwarf the Industrial Revolution that we had in the 19th century. So we have all the tools. The question is, will we have the mindset? Will we have the guts to actually use them, or will we take the coward's way out and just surrender to big government and make that deal with the devil and then have to pay the price?
So again, I would look at who owns real estate and who does not want to own it anymore. And if it's not a big McMansion in the suburb that you're in the markets for the baby boomers are going to be selling, maybe you do want to look into whether or not some second homes are going to be coming on the market and provide good opportunities to buy into for the next generation of renters.
I think a great offensive strategy is to build up your own business. I mentioned building a portfolio of rental properties as a defense, but if you can build your own business, that's really offensive. That's taking the initiative into your own hands and protecting yourself, because surely by now everyone realizes that no job is secure. If you're working for someone else, whether it's a small business or a corporation or a bank, you can be fired the next day at any moment. So if you want to have security, then try to come up with an investment plan that will survive during good times and bad, and build up your own business. Be your own boss. Take your future into your own hands, and don't depend on the whims or the decisions of other people.
Thanks, Richard. Now let's ask your friend, Robert Kiyosaki. Robert, what do you think? Best offensive strategy?
Well, at Rich Dad, we just redefined the goal line again. And we got successful because we were simple. We made the complex simple. And again, the real estate guys are the first guys to have us on there. And all we are is an accounting company. So we decided to make it simpler. So what we're doing is right now, we're doing what's called the Rich Dad's 15-minute business school for entrepreneurs and investors. And so we're going to dumb it down to his little YouTube videos with Tom Wheelwright, Kenny, we're all getting together to dumb it down to sell more of these, cash flow kids games and this game here, and encouraging people to teach people and all this. But the biggest expense we have is Amazon, because we ship such volume. So when we evaluate it is, we're going to convert our office into a warehouse and bypass Amazon. That's about a 50% margin we add to our bottom line. Now, we can't do that yet, but until we say we're going to change the horizon, that's what we're doing. And that's why we're entrepreneurs, not corporate employees. We're going to figure out a way we can do it. So, my Richard always says, don't say you can't do it or you can't afford it. Ask yourself, how can we do it and how can we afford it? So by increasing our volumes over the world, we're making more money than ever before. Cash flow games are blowing out the door, and we haven't even supported it. We have no videos and not telling what it is. So we're cutting these little videos, with Tom talking about accounting and all this stuff, making it simple. But then we take on our greatest expenses, and that's Amazon. And they're ripping us off. Not that I blame them, but they're the 800-pound gorilla sitting on all of us right now. And so let's take them on. So that's what we're doing.
So you're saying Amazon is behind the coronavirus. That's what you're saying.
That's exactly what I'm saying.
All right. Good stuff.
No, it's just that it's called, they're too fat.
Yeah.
Every year they keep increasing how much we have to pay them. And they don't increase their services. If they give us a better service at a better price, that's called capitalism.
Yeah.
What they're doing by giving us less service at higher prices, that's called gouging. And that's unethical in my books. So as an entrepreneur, I just want to take them on. Just like Kenny McElroy says, as a landlord, I can't dun the tenants, but he can do it as a collection agency. And that's what entrepreneurs do.
All right. Thanks, Robert. Robert, I know you're a big fan of Nomi's. Nomi Prins, best offensive strategy.
So I think if you have the wherewithal, the availability of capital, of funds, of savings, keep some of it away, again, for those multiple periods along what could happen. I think in terms of sectors, I do think real estate is a good sector if the math works out. Basically if we have cheap money available right now, if that works out with a leverage that is doable, even if the economy were to turn down aggressively again, then I think that's a good situation. That's something to look for. Those opportunities are something to look for, particularly if you can rent out things along the way in areas where perhaps the jobless rate isn't as high. or in areas where there are more stability in terms of what jobs could come into them. I also think in terms of stocks in that part of the market, I don't try to call a bottom. However, I personally have been legging into technology stocks that can basically straddle the old normal and the new normal, and have sort of very good models and sort of creative ability to straddle going forward, as well as maintain what they have now. And I think that that's going to be a sector that's going to have a lot of potential. And I also think from an infrastructure perspective, I think infrastructure that's going to help from a health standpoint, whether that's hospitals, whether that's transportation to them, whether that's cleaner transportation, because I think what the world has seen is, the possibility of having cleaner air. This is not necessarily the best way to go about doing that, but I do think it's going to get some companies and individuals to think about what could be a better way going forward. So I think in that sector, there's opportunities as well.
Hey, Tom Wheelwright, I know you're an accountant, but you have an opinion on this, don't you?
One of them is anything that deals with technology. I think is going to be a good offensive move. People are, everybody's online right now, and people are getting used to that. So I do think that, as we talk about what strategy we have from an offensive standpoint. Well, maybe we could be a little more aggressive in communicating with our tenants. Maybe we're a little more aggressive in providing education to our tenants, to providing education to other people, so that we're taking advantage of the technology, people being online, people consuming online. I think we want to, I seriously, I think we want to take advantage of that. I think that taking advantage of that technology and that shift, and it was gradual, but now it's been accelerated. I think that shift is going to be amazing, and I think people ought to take advantage of it.
Yes, indeed. Good stuff. All right. Adam Taggart, what do you think? Offensive strategy.
In terms of going on the offense here, I think information and insight is one of the best investments you can be making right now. As we talked about earlier in the conversation, lots of models are being broken right now. There's a lot of transition and transformation that's going on in the economy. We're going to be doing things different ways going forward. If you can find out where the puck is going to be and align your actions and your investment decisions based upon where things are likely to be next, you can be ahead of the general investing public and find yourself getting good values now and then holding much more highly valued assets tomorrow.
And last but not least, Dr. Chris Martenson.
My preferred offensive strategy right now is to develop a buy list so that I know what I'm going to deploy all that dry powder against when the time comes. And people need to understand what value actually is. So if you haven't done the homework, you're not going to know a bargain when you see it. There are going to be plenty of bargains coming, but you got to do the homework. This is the time to be doing that right now. So get your buy list ready.
All right. Well, we cannot thank our panelists enough. Great stuff. As tempted as Russ and I are to now comment on all those answers, we're going to hold that for the next episode in the webinar series. If you're interested in our take and what do we do now, and given all this information, what are some strategies, real estate strategies, that's going to be episode 13. But before we leave this episode, we have some extra bonuses. It's been a lot of great content, but as we've gone through this, we've really realized that there are some ideas that people need to be aware of. And so since you've made it through this far in the series, there may be some homework for you. And the first thing to understand is money. And we have a great bonus courtesy of our good friend G. Edward Griffin, who wrote The Creature from Jekyll Island. Tell us about that bonus, Russ.
Well, it's probably no secret that we've been doing this for a little while, not just putting together this webinar, but doing the radio show for a long time, the Investor Summit at Sea for years and years, 18 years now. And through that time, we've built a lot of relationships with people and put on a lot of events. And so a couple of years ago, we did an event with G. Edward Griffin, Robert Kiyosaki, a lot of Peter Schiff, a lot of the folks that you've heard from and others, it called The Future of Money and Wealth. And if you really want to understand the future of money and wealth, you have to understand the nature of what is money. And Ed Griffin is one of these guys that's been around a long time, has seen a lot. And when he broke down the Federal Reserve and who is the creature from Jekyll Island, and obviously the Fed's been in the news quite a bit, and they're printing a lot of dollars, and people refer to dollars as money, but Ed has a better explanation of what money is, where it comes from, and that really forms a foundation of you understanding all of your investment in the context of what is money and what isn't, and then some of the changes that could come out of this COVID-19 crisis and the reactions to it could affect money as you know it. And so we thought that this would be a great piece of content for you to watch and get your mind around, and nobody explains it better than Ed Griffin.
So that fully produced video, What is Money by Ed Griffin, that is bonus number one. Bonus number two is something Russ did at the Future of Money and Wealth, which is to really talk about the dollar being under attack. And this is one of the themes throughout this series is what does the future look like for the US dollar, all the stimulus, trillions of dollars being printed. And then we've got the whole uncertainty about the global stage. So in addition to that video segment, which was the way we kicked off the Future of Money and Wealth, we've also updated a really cool and popular report of ours. Tell us about that, Russ.
Yeah, so back in 2009, 2010, we started really paying attention to what was going on in the wake of the 2008 financial crisis. And I began doing a thing at our mentoring club called Clues in the News. And that kind of led me down this path of realizing there was so much more going on than I realized. Well, about 3 or 4 years into that, I was doing a presentation at the New Orleans Investment Conference, and I was explaining some of the history of what China was doing in terms of trying to undermine the dollar and how most people weren't paying attention to that. So I wrote the Real Asset Investing Report to kind of explain that in 2013. So it took it from 2009, 2010 to 2013. In the Dollar Under Attack in 2018, I updated it, the presentation, and kind of incorporated a history, if you will, right out of mainstream news. This is not conspiracy theory. This isn't stuff coming from some dark web, area where, only crazy people are hanging out, in
We do like those areas, by the way, but that's
well,
not...
every once in a while you find a nugget of truth out there, but you always want to, corroborate that with something you can find mainstream. But I think you'll be quite enlightened by what has been going on and its relevance right now. China is in the news. The animosity between the United States and China has grown considerably, maybe because of the virus, but maybe because of the tariffs, maybe because there's other things at play. There's a lot of stuff going on. And if you remember at the top of the series, we talked about how the health crisis becomes an economic crisis, becomes a financial system crisis, and then the Fed printing trillions of dollars to try to paper over and protect the financial system could produce a dollar crisis. So if you don't understand what money is, and you don't understand what China is up to in trying to undermine the dollar, then you really wouldn't see the advance warning if in fact the dollar was going to be in trouble. And if you denominate your wealth, if you earn, borrow, pay, collect rents, measure your net worth in dollars, and you don't have an understanding of that, much less a plan, if something were to happen, then you're vulnerable. And we felt like it was very important to get this information in your hands so that you could begin to get a context. So when you're looking at the news like we do, you can go, okay, I understand what this is saying, what this means, and how current events are either creating opportunities or challenges for me that I then need to react to quickly, because everything is happening very fast right now.
So the Dollar Under Attack, again, is a produced video. You're going to love that. Plus, the Real Asset Investing Report is a way to look at real assets, tangible stuff you can invest in. It's also probably the best explanation of understanding, which is so critical as an investor, what the risks are when you have a counterparty. So we've talked on the series a bit about counterparty risk. You have to have your mind around that. So that's a great couple of bonuses there. And then finally, something super current, which is this year, COVID-19 put a big thorn in our side when it came to planning our annual investor summit at sea. For 17 years, we pulled off an incredible culmination of our year with our investor summit. Many of the folks that have been part of this webinar series come regularly to that, and it's incredible. But the part that happens on a cruise ship and the part that happens on a hotel couldn't happen this time, so we ended up with a 3-day virtual event, and one of the panels from that event is going to be bonus material, and you're going to dig it.
Yeah, similar to what we've done here with the lightning round panel, we asked a group of people that had participated in the summit, the virtual summit, to tell us what did they see in the road ahead. Based on everything we just got done talking about for 2 full days, where do they see the road ahead? What type of things? And I think it was Peter Schiff and Chris Martenson, Adam Taggart, and G. Edward Griffin are the panelists. And so very insightful comments. We felt it's relevant, still relevant today. And we wanted to share that with you because we think you'll get a lot out of it.
So there you go. There's the bonuses. And what happens next is episode 13, which is kind of our wrap and our take and our where do we go from here episode. So before you even think about watching that episode, let us just say that what you could do right now, having watched all 12 episodes, is really just seek to understand, as Stephen Covey would say, to start to get some ideas of what to watch, of ideas of where you may want to restructure your plans a little bit, changes to your portfolio, maybe some new things you want to add, and figure that out on your own. And certainly no disrespect if you want to do that. That's why we created this series, not so you could hear more from us. You can listen to our weekly podcast, but so you could hear from some of these incredible people. However, we have a lot of real estate investors that are always struggling with, well, now how does all that big picture stuff permeate down to me as a real estate investor? So the next episode is really that. It's Russ and I kind of breaking down the things we heard, some of the ideas where there might be future opportunity in real estate, massive changes that have happened demographically and through real estate product types based on COVID-19, and some ideas for resources. So that'll be episode 13 as we wrap up the COVID-19 Crisis Investing webinar series. We'll see you there.
Hey everyone, thanks for watching. Before you go, 3 things. Number 1, click the subscribe button, because when we have more subscribers, it makes it easier for us to attract better guests to share great content with you. Number 2 is click the notification bell to be sure that you're notified when we put up new content. This is obviously an ongoing situation. We're going to have continuous discussions about it. You're going to want to make sure that you're kept up to date. And then number 3 is make sure you share it. Tell a friend. Help us flatten the economic curve by getting more financial education out there to people who need it. Okay, so you know what to do. Click the subscribe button, click the notification bell, and we'll see you in the next video.
Systems break, and suddenly your family, friends, and neighbors are distracted with Wall Street stock indexes and Washington political pandering. Many are unaware and unprepared. Like COVID-19, ignorance of looming financial perils is also a disease, and the system is fragile. But you can help. Financial education is the vaccine. Share this free video series while there's still time. Alert people to these serious issues. If things turn quickly, the financial support system could be overwhelmed to the point of collapse. Help flatten the curve and reduce the impact on the financial system. Wake up more people to prepare. You have nothing to lose and a lot to gain. Share this video directly or invite people to visit crisisinvestingseries.com.